Hello and welcome to the Loudon REI Connect uh, virtual meetup. Thank you to all that were able to join us today. We will be posting this recording onto our YouTube channel. So if you haven't already subscribed to our YouTube channel, please take a moment to do so when you have a chance. So this afternoon, I didn't know that the New York Knicks were actually going to be in the playoffs. So this is a normally scheduled event. So to all my New York fans, please do forgive me because I was not aware that the New York Knicks would be in the number 2 position for the Eastern Conference, and we are here. So with that being said, many investors who I come across are not aware that they could be investing in real estate using their retirement funds. And I have personally been investing using my retirement funds since 2015, and I have had a phenomenal amount of growth since that time. So every so often we repeat this event to let other people know what we have updated since that time. As we get started, I wanted to share that this is my disclaimer to protect any and all, right? I am just an investor expressing my personal opinion and not a financial advisor, definitely not your financial advisor, attorney, or accountant. I would strongly suggest to you that you consult your own financial professionals before making any type of investment or financial decisions. One of the things that I wanted to let you know is that we subscribe to a code of ethics where we do not accept any money from any sponsor or platform for anything, including postings, reviews, referring investors, affiliate leads, or advertisement. The reason why I wanted to share and let you know about this is because I want you to know that the information and advice that I am sharing here is unbiased. I am not being compensated in any way for anything that I share on any of our meetups. So let's get started. Today, the agenda is for those who do not know what is a self-directed IRA, right? And then we'll dibble and dabble and explain to you what the difference is between a self-directed IRA versus a traditional IRA. Now, one of the things that we have been talking about in my series is the impact of fees on your investment portfolio because that has a corrosive effect on the compounding that can be had whenever you are investing. So that's something that you have to be critical, especially if you are a subscriber to the FIRE plan, such as me. Then we'll tap into some of the providers that we are aware who can basically help you and get you going on your journey. And then there are certain rules and legalities as to whether or not if you can do this or that, invest in this or that when it comes to your IRA. Finally, we'll just summarize everything that we spoke about within this session, and then we'll go from there. Hopefully, we provide you valuable information that you can turn around and use on your investment journey. Moving forward, what is a self-directed IRA? A self-directed IRA is an alternative to your traditional 401k. It's a tax-deferred retirement platform that allows the investor to diversify, right, beyond Wall Street. You don't have to invest in your self-directed IRA inside of an EFT or a mutual fund. You can invest into alternative real assets that are not available inside of a traditional IRA. Did you know that you could invest in real estate, right? Both directly owned or public and private REITs. You could invest in foreclosures, mortgages. You could be the hard money lender for mortgages. You could invest in precious metals such as gold and silver. Using certain strategies, you can use your IRA funds to start a private business. If you're a hard money lender, you can make private loans. You can also invest in syndications using their private placements. You can invest in commodities, intellectual property like movies, books, and songs. You could also invest in stocks, bonds, and mutual funds. And some people have gotten very creative in their using tax liens. Depending upon which state you are in, tax liens can give you a substantial yield on your money, right? It's a big thing that is going on in Maryland for the most part. Maryland, PA are states where you could invest in tax liens. So those are some of the alternative vehicles that you could actually invest your self-directed IRA in. So let's keep it moving. Right? They say that a picture is 1,000 words, right? Here on my left-hand side, you see common securities, right? That you can invest in using your traditional IRA. We'll just double click on it again. You are able to invest in stocks, bonds, mutual funds, target date funds. And one of the things that I would have to say is when it comes to a targeted date fund, you probably don't want to do that because a targeted date fund has the highest expenses for the most part because it's an actively managed fund. And that actively managed fund moves things around inside of your portfolio, regardless of whether or not if the market is up, down, in between. If there's a targeted date fund, I try to advise anyone who comes across me not to invest inside of a targeted date fund just because it's not very beneficial to you as the in-state investor. When it comes to mutual funds, if you are going to invest in mutual funds, my suggestion is go with an index fund. The index funds have the lowest return, they're not actively managed, and they typically get the same types of return as what the market as a whole is making. So you could go with a total market fund, or you can go with the S&P 500 type of fund. You could also, if you are a stock picker, you can, invest in individual stocks. Nvidia is doing quite well. And if you were a stock picker and you had put Nvidia into your portfolio about 24 months from today, you could probably have, accelerated your portfolio. I think Nvidia is up since 2022 by over 400 to 500%. So there's many different options that you have. But on the other side, the right-hand side that you see before you is something that you can use to invest in using your self-directed IRA that would not be available to you in your traditional IRA. Did you know that you can invest in real estate, either single family, duplexes? Also, you could invest in multifamily deals as well, right? You could also use in a company that I've worked with before in the past called Benetrends. You could actually convert your IRA into an IRA that's owned by the company that you are going to create. And then you have a 401 plan and you can use the monies to start up that business. Benetrends has been around probably for at least 10 years is when I came across them. You could also invest in precious coins and metals, right? You could also invest in Bitcoin. We don't have that here, but if you wanted to invest in Bitcoin, you could invest in Bitcoin as well. Oil and gas, promissory notes, that's going to be hard money lending. Something that I ran across when I was speaking to a gentleman named Parker, who's out of Utah, is that you could actually also invest in livestock. That was one that had gotten me, but when I read the book, I was like, oh, you could actually invest in this as well. So there are many, many different alternative investments that open you up to where you can go when you move out of that traditional lane and you move into that self-directed lane. I hope that's valuable because these are alternatives that many people aren't aware of that they could use their self-directed funds towards. Okay. Now, the impact of mutual funds and expenses on your portfolio is something that I've been harping on probably for the last 5 years, right? And one of the reasons why I try to steer, well, personally, I have steered away from investing with any types of brokers because the brokers typically, unless they are fiduciaries, well, they all should be fiduciaries, right? They charge you a commission, right? When I first got into investing, I had invested with a company called Edward Jones. And the only good advice that I received from that gentleman at Edward Jones was that I should go and purchase my first home, which I did in 2000. Outside of that, he had moved me into, stocks that were in that region, Microsoft, Expedia, all Seattle-based stocks because I was in Seattle at the time. And those stocks performed like a dog. They did not move out. I was holding Microsoft for 10 years when it absolutely didn't do anything. The next fee that you want to be concerned about when you are investing in your traditional mutual fund are redemption fees, right? Those are funds like when you sell, right? There's a fee that is imposed on your shares inside of the fund. Another fund, and all of these funds are going to be inside of the prospectus. I would advise anyone who's going to be investing into mutual funds, EFTs, they have to go and read the prospectus so that they can understand the fees that are going to be charged, right? So you have exchange fees, you have account fees, right? You have purchase fees. All of these little fees are erosive to your compounding as you are moving into these opportunities. And it's not something that is there with every single mutual fund, but there are certain fees that you should be aware of before you move into any of those positions. So on the next page, we're going to continue on and we're going to talk about management fees, right? The if you are a registered investment advisor, et cetera, you are able to charge a management fee where if you aren't a registered investment advisor or a broker, you could only charge a performance fee, which is going to be on the back end. But if you have certain credentials, securities, credentials, et cetera, you can actually charge a management fee. This is what hedge funds do, paid out of the fund's asset to the fund's investment advisor, right? One of the things that you have to be cognizant of, and this is going to be basically in any fund that you have, is look for the 12B1 fees, right? Those are paid out of funds assets to cover distribution expenses. Like this is basically saying whenever there's a distribution, right, it could be dividends, et cetera. These are fees that they're going to be charging you. And while it might be a couple cents here, a dollar there, over a 20 or 30-year period, when that compounding could have been there, guess what? You will see in another graphic that I'm going to show you just a little bit further that this could be corrosive to your overall growth over that time frame. It doesn't kill you. It's like death by 1,000 cuts for the most part. But also, when it comes to many of these different brokerage is they have other types of expenses like you pay for their legal, you pay for their accounting expenses. All of those expenses are going to be corrosive to what it is that you're doing. The final one that we have here from an expense perspective is the total annual fund operating expenses. Now, all of these are going to be documented inside of the fine print, inside of the prospectus, right? But also, you have to go in there and read it. It's typically going to be in a very small text, right? And that's where, the devil is always inside of the details. So, the only reason why I shared that today was so that you could get an understanding of what's going on with all of these expenses and why I have personally taken a route to alternative investments because there are fees there, but the compounding that I can get and the accelerated growth that I can get at the same time, when I have done that calculus, my calculus tells me that that's a better decision where I would want to go. I hope that makes sense to you. All right, moving forward, this is a screenshot from a document that I got from the SEC. And the purpose of this document is to show you the effects of the different fees on your growth, right? Now, down here, what you'll see is that there is a 0.25% annual fee in the blue line that's being tracked over here. There is a 0.50 annual fee on the red line that is being tracked there. And then there is a 1% annual fee that is being tracked with the green line. Now, when it comes to an index fund, you can typically get a fund that's charging you 0.015 is what I've seen with the Fidelity S&P 500 fund. I think it's about 0.015 for the S&P, no, the total market fund at Fidelity. As you can know, I'm with Fidelity. I was with Vanguard at another time, but many of the large brokerage houses, they have these index funds, which are not actively managed funds. And my experience tells me that they have the lowest fees of all. You're going to have to pay fees one way or another. You just want to minimize the amount of fees, just like you want to minimize your taxes at the same time. So the difference here in the highlight of this slide, for the most part, is to show you that over a 20-year period, $100,000 invested with a 0.25 annual fee, right, has the potential to make about $210,000, $209,000 for the total. But with the corrosive effect of fees, if you had a 1% annual fee, you're likely to come in at about 180, maybe $179,000, right? But what you could see, and we talked about this just quickly, is that there's a corrosive effect to your compounding when you are paying these additional fees. And the difference over that time frame is nearly $30,000. $30,000 that could be compounded over the same amount of time, because if you're working a traditional career, if your first job out of college, you're 24, 25 years old, by the time you are 45, halfway through your career, right, you have another give or take 10, 15, or 20 years of growth that could happen. So that $30,000, the difference between that could be $50,000 or $100,000 that's inside of your retirement account, and it's growing at the same amount of time. So it just makes a whole lot of sense that you should be trying to minimize your fees as a whole, because that's going to be beneficial to your growth of your portfolio as a whole. All right. So when it comes to your self-directed IRA, we talked about the different fees that could be there, right? The least that I have seen, right, because the least that I have seen with the setup fees is about $300, $350 as a whole. But I have seen, based upon the different companies who I have interviewed, they can go as high as $1,400. Now, the setup fees are usually going to be there because traditionally you're going to be investing through your self-directed IRA with an IRA LLC. So the IRA will create an LLC, and you will become the managing member of the LLC and get to direct those funds. Where I see that there is substantial opportunity is the annual fees that are going to be way cheaper, right, than if you were invested in a mutual fund, right? Because the fees are typically less than $200, right? $199 is what I'm paying today. So I've seen it as low as $180 when I first started. It was, I think it was $25 a quarter before I transitioned my self-directed IRA. But now that same company that was charging me $25 a quarter, now they're charging $100 a quarter. And that's the reason why I transitioned away from them and moved to another custodian where I'm only paying $199 at the same time. So these are the fees that you have to look for at that point in time. Yes, you are going to become the manager of your self-directed IRA, and you have to do the hard work of figuring out where you want to invest those monies, right? Because the buck is going to stop with you. And when it comes to investing, I always want to bet on myself versus betting on someone else as a whole. So there are going to be fees there. In a future slide, I'm going to talk to some of the different custodians where you could reach out to, because I can't help you to make the decision on a custodian who's going to be best for you. You're going to have to do that homework yourself to determine who would you want to go with for the self-directed IRA. So let's keep it moving. But one of the things that I love to see, right, and the reason why I moved over into a self-directed IRA is because I like to invest in multifamily syndications. And the reason why I like to invest in multifamily syndications is because, as you see over here at the bottom, I can typically over a 5-year period get 110% return on my money, right? And not only that, but I could take advantage of depreciation that is there, etc. It's pretty hard to make investments and with low risk get an 18% IRR or a 9% cash on cash return. What I also like about investing in multifamily syndications is that if it is structured correctly, right, and there is a preferred return, the class of shares, they get paid before the syndicator gets paid. And if you have any other questions at the very end of the presentation, if you don't want to ask in this forum, you could always send me a text message and I'll set up some time with you for a call just to walk you through how to look at a syndication and determine whether or not if that syndication is right for you. But before we leave this slide, the point that I wanted to make is that here you can get 110% return. This was pretty easy to do probably between 2016 and 2020. Now, a lot of syndications are running into a little bit of trouble because there's interest rate caps and things of that sort that are expiring, right? But I do have a significant amount of my own personal portfolio in syndications, and many of them are still cash flowing and distributing dividends on a quarterly or monthly basis at the same time. So if you are going to consider a self-directed IRA, I would strongly suggest that you look at multifamily syndications because they have been one of the best performers that I've seen so far. And also, when you start looking at multifamily syndications, you could also determine whether or not if you want to invest in Class A, Class B, Class C, Class D. And the primary difference between Class A and Class D is how old is the property. So a Class A property is a brand new build. A Class B is probably sitting on 10 years of age. When you get into Class C and Class D, those are going to be properties that typically 20 to 25 years older and above. And those properties are different, are managed differently than what you have to do with a brand new build. So I hope that makes a little bit of sense to you at the same time. So moving forward, where you are going to want to go is you're going to have to go in and do a Google search. If you were to do a Google search, I would tell you to do a Google search on self-directed IRA, right? And you're going to come back with a number of different companies that you can work with. Now, Entrust Group is there, Equity Trust is there, Broad Financial is there, UDirect Services are all there. What you see is the asterisk. And what I typically like when I go in to work with a self-directed IRA is something called checkbook control. You might remember I mentioned that when you create a self-directed IRA, you could have the self-directed IRA create something called an IRA LLC. Because the manager of that IRA LLC becomes you, and one of these companies that have the asterisk next to their name, they become the custodian, right? What this allows you to do is when you are ready to make an investment into an opportunity, you don't have to go and get any clearance in order to be able to make an investment into that opportunity. All you have to do is stroke a check, ACH funds, whatever it is that you want to do, or however you want to seed that investment, you can do it directly through checkbook control. If you were to work with a company like Equity Trust as a custodian, you have to fill out certain paperwork. And what they do is they verify and qualify whether or not if that investment qualifies for something that you can invest in using your self-directed IRA. So I say, if you have an extreme amount of trust in yourself, it's always beneficial to go with a checkbook control. But if you feel as though in times of desperation, you might get a little bit weak and you see that you have a certain amount of money inside of an account and you might spend, I would say go with an equity trust type of company. But if you have that control that you need over yourself, then I would say, hey, it's been beneficial for me to move into a self-directed IRA that has checkbook control. And also down here at the bottom is where you can find a URL in order to be able to get more information on self-directed IRAs, especially those that have checkbook access and control. As I mentioned, there are specific and particular rules about what you can invest in using your self-directed IRA. And previously, I mentioned that you could invest in oil and gas, you could invest in livestock, you could invest in cryptocurrencies, etc. What you cannot invest in, and these are the guardrails that if you are understanding checkbook control, these are the investments that you want to avoid, right? You want to avoid art because it's hard to determine the value of art. Plus, you don't want to have that same artwork that's in your self-directed IRA hanging on your wall, and then there's a fire, right? You don't want to invest in stamps or antiques, right? But here at the bottom is where it gets very particular. You don't want to invest in a private company that employ you or your spouse. But typically, there's one level above you where you don't want to invest in. So, for instance, you don't want to invest in a company that your parents own, right? Nor do you want to invest in a company that's below you, i.e., your children own, right? Those are certain rules and prohibited transactions, right? That if you are in the self-directed control, you want to avoid those. However, if you were to be investing through a company such as Equity Trust, they would ask you those questions and give you the green light to proceed or not to proceed. And those are the differences when you are talking about whether or not if you're going to be investing in a self-directed into those different types of opportunities, right? Now, as they say in life, there's no such thing as a free lunch, right? So when you are investing in your self-directed IRA, you kind of sort of have an advantage that other people do not have. And as I mentioned to you, right, you can use your traditional 401k funds and you can go and invest in a business, right? When you use your self-directed IRA to invest in a business, you have a different advantage to someone who was using tax monies, right? And that is called unrelated business income tax, UBIT. So when that company is filing its tax returns, it's going to generate a K1, and that K1 is going to have certain numbers in certain boxes that let you know that there is going to be a tax and how it is to be taxed. Now, the second one, if you're not going to be investing in a business, but you're going to be investing in like a syndication, the term that you need to understand is unrelated debt financed income, right? And this is a tax on your self-directed IRA whenever there are monies that are borrowed to invest in real estate. So one of the things about investing in multifamily syndications is typically you come to the table with about 30% down, right? 30% on, $1 or $2 million is a typical scenario, right? The rest of that 70% is going to be financed, right? Because you are at an advantage by using pre-tax monies, right? When those K1s are generated, right? You're going to have to be responsible for something called UDFI, unrelated debt financed income. Now, if you were using your self-directed IRA and investing in single family flips where you weren't putting any debt on the property, guess what? It's my understanding that you don't have to worry about UDFI because those properties are being purchased free and clear. But also, when you're using your self directed IRA to do fix and flips, you can't put any debt on it. And the supplies that you purchase to complete the fix and flip, right, that must be purchased using whatever entity or structure that you are using to complete the flip. And we got this information here from Broad Financial, and it was Broad Financial is the company that I used when I created my self-directed IRA, and they sent me a binder with the LLC, and there was all kinds of information that was inside of that binder that helped me to be successful in investing my monies to go forward. So watch out for UBIT and UDFI when you're investing using your self-directed IRA. So we've said a lot, and hopefully we said something that was of value to you. But one of the things that I wanted to let you know is that you can take a traditional IRA or you can take a 401k and you can move those monies into a self-directed IRA. What I have done personally is my self-directed IRA then created an entity called an IRA LLC, where the IRA is the sole owner of that LLC. And what I have done is I have used the proceeds or the monies that have funded that IRA LLC to purchase everything that you see here. I have done hard money loans. I don't do hard money loans anymore because it's kind of hard to get into first trust position. I have purchased, I'm basically at my 26th syndication that I've been involved in at this point in time, right? But there are other investments that I don't want to hold you back from if you choose to go into that direction. You know, I'm limited in how much I can put into this big head of mine. So I can't say what all of those other investments are. I would just advise you is to avoid the prohibited transactions that are going to be disclosed to you that you want to avoid because you do not want to have anyone who represents the government giving you a call saying that you owe them money because you did something incorrectly. So that's the summary for what we have today. As we move on, I'm going to open it up. And if you have any kind of questions, you can just come off of mute and we could open it up.